Hey Bowtie Nation, Joseph Hogue here with what could be one of the biggest surprise turnarounds of 2025, a trend that nobody is talking about yet. Real estate stocks have been dogs over the last few years, plunging 26% on the Fed's fastest rate hikes in 40 years in 2022. A false bounce of 12.4% last year has given way to a 2.5% loss this year. That's a loss of 6.7% annually, and contrasts with a long-term average of 11.8% annualized return over the last 15 years. High interest rates have hit valuations and cash flows for every type of commercial real estate, pushing up default rates and driving those losses. Another trend has been hospitals operating deep in the red. Canceled elective procedures during the pandemic were followed by a labor shortage and inflation that drove costs up for providers. Nearly half of all rural hospitals are operating at a loss, and this year we saw one of the biggest hospital bankruptcies in decades. Putting those two trends together, and the real estate investment trusts or REITs that own hospital properties have been the worst performers in the market. Shares of the largest hospital property owner in the U.S., Medical Properties Trust, plunged 86% in the 2 years to 2024, followed by a 48% loss on shares of both Healthcare Realty Trust, ticker HR, and Healthpeak Properties, ticker DOC. Dividend darling MPW was forced to cut its payout in half last year just to protect that cash flow. But then, like a rubber band that has built up so much tension, stocks in this group could snap higher as both of these conditions turn over into next year. And the best part? Nobody is talking about it yet. Almost half the shares of MPW are borrowed and sold short as short sellers bet that the pain in real estate and hospital providers continues. Another REIT in the space, American Healthcare, ticker AHR, has nearly 10% of its shares shorted, even though it's widely held by long-term institutional investors. So I'm going to show you why this could be one of the biggest stock surprises of 2025 and the 5 stocks I'm buying right now. But first, if you want to see the 5 stocks I'm buying for the next 30 years, my forever stocks, look for the link I'll leave in the description below. It's a free report I put together with the Motley Fool, some of the biggest stocks in my portfolio. These are the stocks I'm following in major multi-year themes, with one of the picks up 100% and the group up an average 94% last year alone. That report is totally free. You're going to see the first stock immediately, then they're going to email you the full report with the other stocks. It's an easy way to support the Let's Talk Money community and see some of my favorite stocks to buy, so look for that link or just scan the QR code here. The first catalyst for these hospital REITs has already begun, the drastic improvement in hospital operations. During and after the pandemic, a severe labor shortage for medical staff pushed up wages while those other costs jumped on inflation. The problem is because of that lag in reimbursement negotiations, hospitals just weren't able to cover these new costs when paid by the health insurers. Revenue at HCA Healthcare, one of the nation's largest hospital providers, rose just 5% a year in the 3 years through 2022, while operational expenses grew much faster. It's led to hospital bankruptcies and closures across the country and missed rents for those real estate companies that own the properties. But the industry is rebounding this year, with HCA and Tenet Healthcare both reporting strong revenue growth and earnings. HCA beat its expectations for earnings and revenue growth in the second quarter and said services that were closed because of the pandemic and staffing are now opening back up. Just recently, hospitals have also won price increases from private insurers, boosting those reimbursements to cover the reality of cost increases over the last few years. Shares of provider HCA are up 64% since bottoming last October, with this year's revenue growth expected to support a 21% increase in earnings. Of course, there are still going to be pockets of weakness in poorly managed hospital networks, but this rising tide of hospital profitability should help lift all boats and flow down to the better rent rolls for those property owners. And that second catalyst, the one that takes hospital real estate stocks from just good investments to some of the best next year, is going to be lower interest rates and the turnaround in the property market. Now, the Fed's fastest interest rate hikes in 40 years may have helped bring down inflation, but the cost was a complete sacrifice of commercial property values. While the Fed won't lower rates as quickly as it raised them, we now have a clear view of when those rate cuts are going to begin. In its meeting last week, the Fed did hold rates steady, but hinted at cuts on the way, citing further progress on its 2% inflation goal. The Personal Consumption Expenditures Report, or PCE, showed an annual inflation at 2.6% pace last month and just 2.3% annualized over the last 3 months, so we are getting closer to that goal. On recent data, the market is now pricing in a near certainty of first rate cuts in September 18th meeting, just 6 weeks from now. So you put these two catalysts together, and hospital REITs could be some of the best stocks to own over the next year. I'm going to highlight 5 stocks to buy, but understand we're not talking about all healthcare real estate stocks here. We're going to use the NAREIT, their National Association of REITs database, to research our stocks. You can go here to REIT data in the menu, then to REIT Watch. It's a monthly publication of data and valuations on these real estate stocks. Now, there's a lot of great information here. Anyone with REITs should check this out, but we're going to scroll all the way down to the last tables, statistics for each REIT by property type. If we scroll down further here to the healthcare group, we see there are 16 real estate investment trusts in healthcare, but the two catalysts aren't going to benefit all of them equally. For example, looking at LTC properties, we see that it's mostly in senior housing, with 50% senior housing and 50% skilled nursing, not something that's going to benefit from that rebound in hospital operations. On the other hand, looking at Global Medical REIT, a GMRE, we see that it's in the kinds of healthcare facilities and clinics that will benefit. Within those hospital-focused REITs, we have American Healthcare REIT, ticker AHR, Community Healthcare Trust, CHCT, HealthPeak Properties, ticker DOC, Global Medical GMRE, Medical Properties Trust, ticker MPW, and Healthcare Realty Trust, ticker HR. And there's a lot of information here with each, but we're just going to be covering the basics before we look at my top 5 healthcare REITs. Now, you see in the table across the top, this FFO, that stands for Funds from Operations, and that's the key measure of cash flow for real estate stocks. Anytime you're analyzing REITs, you want to start with this FFO, the FFO growth, and the valuations. Now, on analyst forecasts, we see FFO in the space is expected to grow between 4 to 8% for most of these companies over the next year. We do have a few outliers like American Healthcare with its 10% FFO growth that we would want to research further, as well as the negative 0.15% FFO growth on MPW. This debt to EBITDA, or earnings before interest, taxes, and depreciation, is another important measure for real estate stocks. This is the debt burden over the company's core earnings, so gives us a sense of financial health and stability. Here again, we see most of the REITs in that range from 5 to 9 times debt to EBITDA, though we do have those outliers like MPW. Last, before looking at those individual stocks, REIT investors are always interested in these dividends, with the group paying an average 6% yield, about 4 times the yield you get from the overall stock market. The outlier again here is MPW, with its 11% dividend yield, something you'd want to make sure is sustainable being so much higher than the rest of the group. First on our list, American Healthcare REIT, ticker AHR, more diversified than the others, with 19.5 million square feet across its U.S. properties and 318 buildings in Europe. Outpatient medical is only about 4.4 million of the total square feet here, but makes up 27% of net operating income. Being more diversified across property types, it's not going to benefit quite as much from that hospital catalyst, but is likely to be a safer play also. We do see that AHR is expected to post strong FFO growth above 10%, though shares are already relatively pricey at 12 times, so much of that outperformance is reflected in a more expensive stock. It also offers one of the lowest dividend yields at just 1.7%, so while it can be on your radar, I'd look elsewhere for better returns. Global Medical REIT, ticker GMRE, is a smaller player at just $630 million, but offers a much higher dividend yield at 8.8%, and is more focused on the theme that we're targeting. Of the 4.8 million square feet and 185 buildings, almost a fifth is in the inpatient services, and 68% in medical office buildings and clinics. FFO growth is a little lower here at 5%, though the valuation is also lower at a price of 11 times FFO, so shares are relatively cheaper than American Healthcare. The debt to EBITDA is higher than the others on the list, so a little more risk, but I do like GMRE as one of my top 3. Community Healthcare Trust, ticker CHCT, plunged 19% after reporting its second quarter FFO that lagged expectations, but could be an opportunity to pick up the shares on a cheaper basis. It's another smaller property owner with 198 properties, mostly in medical office, inpatient services, and specialty. We see fairly good tenant diversification, something that has become very important given MPW's pain over the last few years. And while that weak FFO report last quarter put its 6.3% annual growth in question, the big drop in the stock also puts that price to FFO down to under 9 times, which would be one of the cheapest in this space. On the solid 6.7% dividend yield, that makes it worth the risk to get in on this one on a rebound. Healthcare Realty, ticker HR, is a larger one on the list at $6.8 billion market cap and 40 million square feet. Almost all of this, 93%, is medical office and outpatient buildings, so not hospitals, but also the kinds of services that should benefit from that rebound in hospital operations. FFO growth is lower here, only expected up 4% this year, and the debt ratio is higher, so I don't think this one makes my top 3, but that 7% dividend and relatively cheap valuation does make it one to watch. Before I highlight that next stock, the highest dividend on the list, if you like that cash flow, you're going to want to check out this video next. Of all the monthly dividend stocks, this is the one all investors should own. And we couldn't do a healthcare REIT video without talking about Medical Properties Trust, ticker MPW, with its 12% dividend. And this is the largest owner of hospital property in the U.S. with 436 properties, directly in that inpatient hospital rebound theme that we're talking about. MPW was the hardest hit by those hospital troubles over the last few years, and you see it in some of the stats here. FFO growth is still expected negative this year, and the company's debt is out of control at 51 times EBITDA. Still, it's also trading at fire sale prices at under 6 times FFO and is actively monetizing properties to pay down that debt. For that, I own shares of MPW, and I like the risk reward here. Shares are trading as if the company won't be able to dig itself out of that hole, but that rebound in hospitals along with the interest rate stories, I think enough to put it on a better footing. When that happens and we see less uncertainty in the company's future, the shares could jump and would be the best return of this group. Get your free report and see the stocks I'm buying for the next 30 years, up an average 94% last year alone. Or click on the video to the right for the one monthly dividend stock I'm buying right now. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.